Okay, good afternoon and welcome everyone to our new 2020 Options Master Courses. My name is Tony Zhang. I'm the Chief Strategist here at Options Play, and I welcome everyone here today to embark on this journey that we have in 2020 to help you better understand how to utilize options. We've partnered with the TMX in bringing you a group of tools to allow you to learn how to trade options, and then more importantly, giving you the tools that you need to be able to implement, analyze, and hopefully execute those strategies in your own trading account, and doing everything we can to help you along the way to learn different strategies, learn best practices, and even show you and answer your questions as you go along so that you have all the support that you need before you execute these option strategies for your portfolio. Now, today is just part one of a multi-video series that we'll be doing here. In March, we're going to be doing 3 separate videos. Part one is really dedicated to the benefits of trading options and what you'll receive from learning how to trade options. Then we'll talk a little bit about the difference between buying and selling options in part two, before in part three, where we spend a lot of time going through real market examples, showing you how to apply what you've learned in part one and part two in the real markets and answer your questions. So we're really changing the format of how we do education here in 2020. For those of you that joined us last year, welcome back. I hope that this is a continuation on your options education journey. For those of you that are brand new to Options Play or brand new to our education, welcome. I really hope that this inspires you to take a look at options in your portfolio. So let's go ahead and get started since I have a lot to cover here today. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a solicitation or a recommendation to buy or sell any specific securities. And for those of you that are brand new to Options Play, you can sign up for the platform that I'll be showing you here today completely free of charge, courtesy of the TMX. What you're going to get access to is a free Options Play Canada platform, which gives you access to a tool that allows you to analyze and explore different option strategies. As you learn these strategies, you can apply them to the symbols that you want to pay attention to. Grants you access to bi-weekly educational webinars like the event that you're on here today, and access to the free on-demand video library so that if you want to go back and review any of the previous courses that we've recorded in 2019 and all the ones that we'll be recording in 2020, you'll be able to watch those at any time. For those of you that are already subscribers to Options Play, you receive the weekly cover call or short put reports, which are sent every single Monday so that you have a way to help you implement some of the strategies you'll learn in the coming weeks. So this is all designed to provide you with the different educational and tools that you'll need to support and learn how to trade options. So for those of you that are brand new to Options Play, I highly recommend you to sign up using that link. Again, it is completely free of charge, courtesy of the Montreal Exchange. Now, what we're going to do today is we're going to look at predominantly the benefit of trading options. And the reason we're going to do this, of looking at the benefit of trading options, is really because I want to paint a picture for those of you that are brand new to options, and understanding as to if you are to embark on this journey, because it is something that takes quite a bit of time and effort to learn how to trade options. I want you to understand, if you embarked on this journey, what would you get at the end of that? So giving you a sense for why should you, giving you a sense for why should you trade options, and understanding what are the primary use cases for trading options. And in a market like today, or let's just say the past couple of weeks, there are going to be different reasons why you're going to want to leverage options. Now, first and foremost, the most popular strategy is income, but I will say, given these days that we're currently in, I think income is probably secondary to what are some of the other strategies that we'll talk about here today, which is utilizing options to apply leverage and do so in a way of limited risk, as well as protecting your portfolio, something that I think is high on a lot of people's minds, before we talk about the call and put basics. So that, you know, again, jumping a little ahead, giving you a glimpse as to what will you get at the end of it, and then coming back and starting from the very basics. So I do have these dates here, I believe, are wrong. So I will make sure that I correct them before I send out the slides after today's recording. But part 2 and part 3 will be coming in March, and we will send you emails with when those events will be so that you can come and attend those as we go along. So every single month we're going to have a new master course. So every single month you're going to learn part 1, part 2, and then a live market analysis, so that every single month you have an opportunity to reflect on what you've learned. We'll sit down together and apply them to the real markets and answer any questions before we move on to the next month. So that's going to be the new format for education here in 2020. So before I get started, I just want to do a quick poll here. If everyone could please answer the poll on your screen, just to get a sense for the audience here in the room. What is your experience with options trading? Are you brand new to options trading, or do you have some experience trading, or are you already an experienced options trader? I just want to have a sense for the audience here in the room. Okay, so with at least half of you voting, it looks like it's a pretty even split between those of you that are just learning and those of you that have experience trading. And only a few of you say that you're an experienced options trader, which is fantastic, because this gives me an understanding of the audience, and I'll make sure that we tailor today's education to that. So just to give you a sense here, so the vast majority of you, or the majority of you here, are learning how to trade options. So welcome for all of you that are in the process of learning how to trade options. Some of you may be ahead of others, but this is a beginner's options master course to really start you from the very beginning. So most of you fall into this category. For those of you that have some experience trading options, what I really find what's valuable about this course is being able to provide you a look back on the fundamentals of options trading, because they are absolutely critical to understanding more complex strategies that will eventually be useful in your portfolio, because they are all built on the same fundamental building blocks that we're going to discuss here today. So I really encourage, even if you have experience trading options, to pay attention today and learn the fundamentals, because we're going to utilize and build on these fundamentals as we progress through the master courses into the intermediate and advanced courses. So we have a lot to share with you in the month of March. We have a lot to share with you in the year of 2020. And for those of you that have participated in the options education days in the previous years in Montreal, in Toronto, in Vancouver, or even Calgary, for those of you that came out to that, we're going to be doing those digitally this year so that all of you can attend, not just the ones in those geographical areas. So really excited about what we're going to provide to everyone in terms of education in 2020. So let's go ahead and get started. And for those of you that don't know who I am, my name is Tony Zhang. I'm the Chief Strategist at Options Play, which is the technology or the tool that you have access to free of charge, paid for by the TMX. I'm also on CNBC on Fridays at 5:30 p.m. on the Options Action Show. For those of you that are looking for ideas and looking for an understanding of how you can play the markets, that is one place that you can come and participate and see the different ideas that we as strategists throw out for our own trading accounts, and so that you can see how we trade. So for those of you that are brand new and you're looking for ideas and you're looking for inspiration, I recommend you to take a look at that show as a way to widen your experience as far as what options trading can do for you. Okay, so let's go ahead and get started. Let's talk about why you want to trade in options. So everyone here, predominantly here, I believe, is here to try to participate in the markets. Now, can everyone please bring up your chat window, which is at the bottom of your screen? And please type yes if you trade stocks or ETFs in your portfolio. And please type no if you do not trade any stocks or ETFs in your portfolio. Okay, so I predominantly see pretty much all yeses. I see a couple of no's, but almost entirely all yeses, meaning in some way, shape, or form, whether through options or stocks, you participate in the markets. For those of you that answered no, well, I hope that this inspires you to take a look at why you should consider participating in the markets. So for those of you that are trying to participate in the markets, why should you trade options, or why should you potentially leap from trading stocks over to trading options? Now, first and foremost, and I think this is what brings most investors interested in looking at options, is the fact that you learn that you can utilize leverage, which many times I know is seen as a double-edged sword, because if you get the direction correct, leverage can certainly help you a lot, but if you have the direction incorrect, it can be very painful. So one of the things that you'll learn is that options give you leverage with limited risk, so that if you trade in the direction that you expected to, you can get leverage. If the trade goes against you, you have limited risk. And this is one of the most attractive parts about options, is that asymmetrical risk, that if you get the direction correct, you can make a lot of money. If you get the direction wrong, you can lose a limited amounts of money. You don't have to risk as much money to do so. So that's something we're going to explore heavily here today. The second reason, and this is actually the most popular strategy, is actually income generation. So once users, many times are attracted to options, they learn about it, but the strategy that they actually implement the most in their portfolio are actually income generation strategies. So we're going to discuss some of those here today. And lastly, most importantly, is to create customized payoffs. And the reason I say this is because as a stock investor, all of you that answered yes, you're familiar with a stock trade that either goes this way or goes this way, meaning it's a very straightforward payoff graph. If the stock goes higher, you make money. If the stock goes lower, you lose money. And you really can only trade in one direction in stocks that you think are going to move higher. Conversely, when you're trading options, what you can do is you can actually trade using customized payoffs. So if you think the stock is going to move up a little bit one month, and you think it's going to go significantly down the next month, and then it's going to trade sideways here, you can create customized payoffs that allow you to make profits if that actually does work out for that underlying stock. And you can have various ways that you can think about where you think a stock will go, whether it's based on fundamentals, whether it's based on news, whether it's based on technical analysis. There's lots of ways many of us trade stocks, and we can utilize options to create these customized payoffs that give us profits, or provide us with profits, if the stock acts in a certain way. That doesn't have to just go up or down. So that's the primary reason why many people utilize options to trade in the markets. The second most important reason, which I actually think is very relevant to the market that we're in right now, is mitigating risk. Many times we don't think of options as a tool to help us mitigate risk. A lot of investors feel that options are very risky. I hear that a lot from beginners or users who are in the process of learning how to trade options, or maybe have even traded some options and maybe lost some money in their account, say that options are very risky. So that's why I want to explore, how can we use options to mitigate risk? How can we use options to reduce the risk in our portfolio? Because that's actually the primary reason as to why you want to utilize options, is actually to reduce risk. So we'll talk a little bit about how you can protect your portfolio and your profits utilizing options. So let's jump into the individual examples here. So first and foremost, despite the fact that many of us come to learning about options purely based on the leverage and the idea of being able to speculate on directional views, what people actually trade are predominantly income generation trades. And this is because this is a strategy that doesn't require you to have a strong directional view on a stock in order to trade it. Most other strategies that give you leverage with limited risk requires you to have a strong directional view on a stock. And we don't always have a strong directional view on a lot of different stocks. Many times you might have a view that a stock isn't going to move very much, and that's not very suitable for a trade that applies leverage. So that's why the most popular strategy is income generation. And this is for all of you that answered yes to owning stocks and ETFs. So for those of you that own stocks and ETFs, one of the primary use cases for options for you is to add yield to your stock or ETF portfolio. So if you look at the average dividend yield of most portfolios, it probably averages somewhere in the 2% range. That is probably the average dividend yield, I would say, on most well-diversified portfolios. Some of you have very dividend-focused portfolios that might have higher yields, but generally speaking, most well-diversified portfolios are in the 2% range. And many times when we're thinking about options, we think about options as a vehicle to help us speculate. We usually don't think of options as a vehicle that allows us to buy and sell our securities. But what you're going to learn in the next few weeks is that options do not necessarily have to be utilized in a way to speculate at all. You can utilize them to buy your securities. What you'll learn is that you can buy your securities at a discount and sell your stocks or ETFs that you own at a potential profit as they rally. And utilizing options to buy and sell your securities generates yield many times in excess of 4 or 5% in yield to do that. So what you're doing many times is you're doubling your dividend yield from 2% to 4%, 4 to 5% many times by utilizing options to just simply buy and sell your securities. And it really has nothing to do with speculating. And this is, again, why one of the primary reasons why just stock investors or ETF investors that may not even necessarily have an interest in speculating using options may use cover calls and cash secured puts to be able to increase the dividend yield, or increase the yield rather, on their portfolio. So as you progress through the education over the next few weeks, and one of the strategies we're going to cover here today is selling call options. And this is actually a beginner strategy that you can utilize to generate additional yield on the stock portfolios that you'll earn, that you currently own. The second trade you'll learn is a cash secured put. This is a strategy that allows you to buy stocks and ETFs at a discount. So imagine if you got a discount on every single stock purchase or every single ETF purchase, usually in the 1 to 2% range. If you got a 1 to 2% discount on every stock purchase, what would that do for your yield, or what would that do for your overall portfolio? So this is how you can utilize options to start improving your stock portfolio before you spend a single dime speculating on the overall market. And then for those of you that are a bit more advanced, there are what we call credit spreads. These are strategies that allow you to generate income without either owning or wanting to own an individual stock. This is a more advanced strategy, just to give you a sense for what you're going to learn from the beginner webinars or the beginner master courses here in 2020, what you'll learn from the more intermediate ones, and what you'll learn in the advanced ones, just to give you a bit of a look ahead into understanding how you will be able to utilize options at the end of the educational journey that we have here planned for you in 2020. Now let's move on to, I think, the sexier part of options, the part that attracts a lot of users to why they want to utilize options. And that, again, is to trade with limited risk and capital to control a larger amount of capital than you might necessarily have or want to contribute to an individual trade, and allow you to control 100 shares of stock with a fraction of the capital that's required to buy 100 shares of that stock. And what's, I think, attractive for most users for this type of strategy is not necessarily just the leverage and the ability to control 100 shares for a small amount of capital, but more importantly, the ability to do that with a limited risk. So two of the strategies we're going to discuss here today are buying a call option, which is a beginner bullish strategy, buying a put option, which is a beginner bearish strategy. And right here, just by learning how to buy puts, many times this expands your horizon by doubling your potential opportunities. Many times as equity investors, as stock and ETF investors, we only seek ideas that were stocks or ETFs that we think are going to rise, because that's the only way we can make money from that stock or ETF trade, is by buying a stock at a lower price and hoping to sell it at a future time at a higher price. Now, most of us as equity investors may not have the ability to or may not want to short a stock. So there are limitations to shorting stocks. However, when you buy a put option, you can now seek stocks that you think are going to decline in value. And that immediately opens up potentially twice the number of opportunities for your speculation, whether you think, and especially in this type of market environment when everything is going down, that might be attractive strategy for those of you that believe that markets are going to continue moving lower, and that's a very high possibility that might happen. So buying put options is a strategy we're going to explore here today. Now, it's really important for everyone here to understand that what we're doing here is helping you define what these strategies actually mean, because when we say bullish or bearish, there are caveats and there are nuances to bullish or bearish that differs between stocks and options, and that's what we're here to explore and show you how to utilize those properly. Once you learn the basics of buying a call or a put, that's when we can get into the more advanced strategies. So one of the strategies we'll cover in the intermediate class is debit vertical spreads, buying calls and buying calls and selling calls at the same time that give you an added advantage by further limiting the risk that you take on an individual trade. And for those of you, again, for the more advanced traders who want to generate income, selling credit vertical spreads are also a way that you can utilize options to speculate on the outlook on an individual stock. So you have a lot of different ways that you'll be learning over the next few months as to how you can utilize options to take different views in the market and do so all with limited risk. And lastly, mitigating risk and protecting profits. This is actually the topic that, generally speaking, we talk about the least, because it's also the strategy that you generally need the least. So if you think about the last 10 years as the markets have ran its bull market, there really hasn't been many opportunities to utilize a hedge or try to protect your profits. They tend to happen once in a blue moon. They tend to last relatively short amount of times compared to the bull markets. So this is a strategy that we, generally speaking, as options traders learn, but we keep in our back pockets until we actually need them. Last week was a prime example of when you might want to utilize a hedging strategy or when you might want to put on a protection trade. So this is a strategy that I will spend quite a bit of time. We're going to spend a whole educational event on helping you understand how you can utilize options to mitigate risk and protect your profits in your portfolio. And what it really does is it helps you protect your portfolio against a market downturn. This usually means a market downturn greater than roughly 5%. So if you think that the markets are going to decline more than 5%, that is when you might want to put on a hedging trade. So if you think the market's going to correct 5%, 10%, 20%, 50%, think about putting on a protection trade. And this is really for those of you that have equity investments. So all of you that answered yes to owning stocks or ETFs, this is a strategy that you absolutely should, at the very least, learn to apply. You may not have to apply it very often, and you might find yourself that when you need to apply that there are better alternatives, but it's a very important strategy to keep in your back pocket so that if and when you need it, you already have the knowledge as to how to apply, and you have the tools to help you analyze it to ultimately trade in your portfolio. And this is a fairly simple strategy because before we talked about buying puts as a bearish strategy. That is the same strategy that you're going to learn in your beginner courses to help you learn how buying a put option can be utilized to protect your portfolio. As a more advanced strategy, what you can do is you can learn how to buy put spreads. And one of the things that we're going to discuss is how buying protection like this typically is expensive. So buying put spreads is a more advanced strategy that allows you to buy this similar protection, but do so in a way that's a little cheaper and risk less money on that individual trade. So this is a bit of a look ahead into, if you embark on this journey with us to learn how to trade options, the beginner courses, the intermediate courses, the more advanced courses, what you'll actually learn or what you're going to get out of all of this, so that before you spend the hours of time that it takes to learn these strategies, you already have a good sense of what's waiting for you at the other end, okay? So that's why I wanted to take the time to help you understand what options traders like we do, like us, have access to, or what can we do with our portfolios that perhaps you might not be able to do right now as an equity investor, and show you what you'll be able to learn through these courses. Okay, so with that, let's jump into some of the option basics. So for those of you that are brand new to options, this is really a primer, a beginner course, right? And for those of you that have experience options, trading options, this is designed to give you a refresher on the basic fundamentals. Now, every single options course will have a slide or language that looks like this. And I will say, I absolutely hate teaching this slide, because an option is really just a contract, right? And just like legal contracts, they are difficult to read at best. And that's exactly what an option contract also many times confuses most first-time readers, because when I teach an options, or anyone that teaches an option contract will tell you that an option is a contract that provides the buyer of the option the right, but not the obligation, to buy in the case of a call option. Excuse me. Let me start over. An option contract provides the buyer of the option the right, but not the obligation, to buy in the case of a call option, or sell in the case of a put option of an underlying stock or ETF at a specific price on or before a specific date. So that's a mouthful. And for everyone that's brand new and maybe have never seen this before, I don't expect you to read this and know what an option is, because it's a mouthful, and you probably have to read this about 8 times after you've learned what an option is to really understand this legal jargon. So what I'm going to do is I'm going to try to break this down to you with real examples and show you what this means. But it's important to remember a few things. Number one is that there are 2 types of contracts. There's a call option and there's a put option. A call option gives you the right to buy. A put option gives you the right to sell. And there's always 2 sides of an option contract. There's the buyer of the contract and there's a seller of the contract. So the buyer is really the person that's buying the right to do this. The seller is the person who has the obligation to do whatever the buyer wants at a specific price. Now, the second thing you want to remember is that there's always a strike price, meaning there's an agreed upon price at which this buying or selling has to happen at. So whenever we talk about has the right to buy in the case of a call option and the right to sell in the case of a put option, they need to be able to buy or sell at a specific strike. And that's what we refer to as the strike price. And an option contract has an expiration date, meaning the buyer has to exercise his right to buy or sell that underlying stock by a specific date, or what we call the expiration date. So those are the key terms to remember. And what we're going to do is we're going to jump through a few examples to remember or to better understand this type of contract and why you should consider looking into these types of contracts. And it's important to remember that the buyer is always the person who pays the premium, right? So because the buyer is the person who's buying the option or buying the contract, they will always pay the premium to the seller. So the buyer always pays the premium to the seller, and the buyer always initiates the right to buy or sell on that individual contract. So again, it's a mouthful. I don't expect everyone to remember. So let's look at a real example to help solidify what we're learning here. So as I said in the previous example here, you have the buyer and a seller, and then you have a call or a put. So what that first means is that there are 4 possible combinations that you can trade. You can buy a call, you can buy a put, you can sell a call, or you could sell a put. And on every transaction, there's 2 sides on each party, and each party is on the opposite end of a trade. Now, with each contract, you have a stock or ETF, you have a strike price, and you have an expiration date. So you have to define what stock you're going to buy or sell, what price you're going to buy or sell it at, and what date you have until to do that trade, right? And whether you're a buyer or seller. Now, This many times can be confusing, especially for first-time users. Is, oh, why would I want to buy a stock? Why would I want to sell a stock? Why would I want to even have the obligation to have to buy or sell, right? And that can be confusing. So one of the ways that we can first initiate or start thinking about these types of strategies is breaking them up into bullish and bearish strategies. So you have 4 possible combinations. You can buy call, buy put, sell call, sell put. And this can be confusing for many users. So the best way, in my opinion, to learn is by using simple math, simple multiplication. So what I have here is I have buy as positive and sell as negative, which I think is a fairly self-explanatory as to why we're assigning positive and negative to buy and sell. And then what we're going to do is we're going to assign positive to call, and we're going to assign negative to put, because a call is the right to buy and a put is the right to sell. And what you're going to do is you can use basic multiplication to determine whether a strategy that you're trading is bullish or bearish. And these are the absolute 4 fundamental building blocks of all option strategies. So once you learn these 4 and what they're bullish and bearish, you'll be able to apply them to much more complex strategies because they're all built on the same building blocks. So if you're trying to buy a call, that's a positive and a positive, that results in a bullish strategy. If you're buying a put, a positive and a negative, that results in a bearish strategy. Selling a call is a positive and a negative, that's also a bearish strategy. Selling a put is a negative and a negative, that results in a bullish strategy. So there are 4 possible combinations. Buying a call and selling a put are bullish. Buying a put and selling a call are bearish, okay? I just want to make sure everyone understands that before we move on. So if you can please type 1 into the chat window, if that makes sense to you, the basic multiplication table to help you remember whether you're trading a bullish or bearish strategy. Please type 1 into the chat window. Okay, perfect, great. I see a lot of 1s. So, you know, we have still about 15 minutes, and what I want to do is I want to go through some examples and show you why someone might want to buy a call option, why someone might buy a put option. So the example I'm going to use here is, let's say I have stock XYZ, and stock XYZ is currently trading at $100. So what I'm going to do is I'm going to walk you through buying a call option, selling a call option, buying a put option, and selling a put option to help you better understand the strategy. And we're going to try to use some examples here. So let's do this. Instead of using this $100 call option at $3, I'm going to use a real stock here. Now, let's take a look at, I'm going to use National Bank here, right here. National Bank of Canada, trading at around $69.93. It's just around $70. So what I'm going to do is I'm going to look at buying a call option. I'm going to look at buying, let's say, a $70 call option. So I'm going to look at maybe I'll look at the April $70 call option for $1.50. Okay, so let's do this. This is National Bank. I'm going to write this down. National Bank. We're going to look at buying the April $70 call option for $1.50, right? So what does buying a $70 call option for $1.50 mean? So if I buy that call, what I'm doing is I'm buying the right to purchase National Bank stock at $70 sometime between now and April. So this is the April expiration. Pardon my poor handwriting. I'm buying the right to purchase National Bank stock at $70 sometime between now and April 17th. And what I'm doing is I'm paying $1.50 for that right. Okay. So what I'm going to do here is I'm actually going to walk you through this example and say, well, what happens if National Bank between now and April 17th goes higher, if it goes lower, if it stays exactly the same? What does it mean to be a call buyer? Okay, normally I use the stock XYZ example, but I think using a real example of a stock makes it a little easier to understand. Okay, so National Bank of Canada is trading at $69.93, right? So just around 70 bucks. And let's say 2 months from now, by April 17th, the stock stays at roughly $70. Meaning, let's say 2 months from today, on April expiration date, the stock is trading at exactly $70. What does it mean as a call buyer? It means that I have the right to buy the stock at $70 from the seller. Now, as a transaction, that doesn't make a lot of sense. Meaning, for me to buy something for $70, that's worth $70. It's not that it doesn't make any sense. It's just that I won't make any money off that transaction. If I buy something for $70, that's worth $70. I'm not making any money in that transaction. That's a net zero transaction. However, as a buyer of an option, I paid someone $1.50 to get into the trade. So what does that mean? If the stock stays at 70 bucks a month from now, by April 17th, what is my gain or loss on that individual trade? If anyone wants to shout that out into the chat window, feel free to do that. But the answer to that is I've lost $1.50. And the reason for that is because I paid $1.50 up front, and the transaction is worth zero to me at the present time, because I can buy a $70 stock that's worth $70. So if I exercise that call and I sell the stock on the open market, I gain $0 on it, but I paid $1.50 to get into that. So at $70, guess what? I lose $1.50, right? So right down here is negative 1.5. So if the stock stays at $1.50, guess what? If it stays at 70, I've lost $1.50. Okay, does that make sense, everyone? Please type 2 into the chat window if that makes sense. Now, this is true for any price below 70, because if I had to buy the stock from someone else for $70, that was worth less on the open market. So if the stock is trading at $65 now, why would I pay someone $70 for a stock that I could just buy on the open market for $65, right? So anything below $70, it doesn't make sense for me to exercise this call. So as a call buyer, what happens is that I basically lose $1.50 no matter what if the stock goes below $70. So basically at any price below $70, I've lost $1.50, okay? Because it just doesn't make sense for me to buy the stock from the seller for 70 bucks if I can buy it somewhere else for a cheaper price, if I can buy it on the open market. Now, let's say at expiration, the stock moves up a little. Let's say it moves up to $70, $71, $71.50. The stock moves up $1.50 by expiration. So what happens now? And again, for those of you that are experienced in options trading or know the answer, feel free to shout the answer out in your chat window. But the answer is, if the stock is worth $71.50 at expiration, what happens is now I can buy the stock from the seller for $70 and immediately go on the open market and sell it to someone else for $71.50, right? So I make $1.50 to exercise my call option. So at $71.50, it makes sense for me to exercise that call. But remember, I paid $1.50 up front to get into this trade. So yes, I make $1.50 on the transaction, but I already paid $1.50 to get into the transaction. So the net on my trade is actually zero. Whoops, let's see if I can fix this. So the net on my trade is actually zero. So at $71.50, I basically break even, right? I don't make any money, I don't lose any money. So let's take this a little further. Let's say the stock goes up to $73 by expiration. Now, again, I can buy the stock from the seller for $70. That's now worth $73. So guess what? I can make $3 on that transaction, because I can buy it from you for $70 from the seller of that option for $70. I can immediately go on the open market, sell it for $73. I make $3 on that transaction. But again, I paid $1.50 to get into this trade. So my net on this particular trade, if it goes up to 73, is that I make $1.50. And what you'll see is that as the stock goes higher and higher, I can continue to buy the stock for $70 from the seller, and immediately sell it on the open market for a higher and higher price. So what you're going to see is that as the stock goes higher and higher, what you get is higher and higher profits. So when you think about buying a call option, there's a couple of things that you need to think about. Number one, we said a call option here is bullish, right? And we clearly see that if the stock goes higher after I buy my call option, I can make more and more money as the stock goes higher. But if I'm wrong, right? If the stock goes down, even the stock goes all the way to zero, the most I'm risking is that $1.50 that I'm paying for that call option, right? That's the most that I can lose no matter what happens. That is the limited risk factor that we're talking about on a call option. So I'm controlling a $70 stock for just $1.50, meaning I have the option to buy a $70 stock for just $1.50. And if the stock keeps going higher and higher and higher, I can make more and more money because I can buy it for 70 and immediately sell in the open market for more and more money if the stock goes higher and higher. But if the stock goes lower, I have limited risk, okay? So that's how we get this payoff graph that looks like this, that many of you are probably familiar with. But the key thing to remember here is that not only do you have to be bullish on national bank stock, you have to be bullish by a certain amount. You have to believe that the stock is going to rise by at least $1.50. So you have to ask yourself the next time you buy a call option, the question is not, are you bullish on the stock? The question is, are you bullish by a certain amount? And that amount is how much you're paying for that call option. So you have to actually look at how much does a call option cost and then factor out how much does the stock need to move in order for me to make money on this trade. And that's a very important lesson to learn for any trader, is that when you're buying a call option, you're not just looking at a bullish strategy, you have to also consider how much does that option cost, because if instead this option costs $3, then you not only have to believe that National Bank of Canada is going to go higher, you have to think it's going to go up by at least $3. And then you'd have to go back to the drawing board and say, well, do I think the stock's going to go up by $3? It's currently trading at $69. Do I think it's going to go all the way up to roughly 73? If you do, then it makes sense to buy that call option. If you don't, it actually does not make sense to buy that call option because you could actually lose money even when the stock goes higher. And that is a very counterintuitive thing to learn when you're trading options, is you buy a call option, the stock goes higher, but you actually lose money. So it's really important to remember how far does the stock need to move. In this particular case, it needs to move about $1.50 higher. And only if the stock moves $1.50 higher, it doesn't make sense to buy that call option. It's very important to understand this concept that when we refer to call options as bullish, it's not just saying it's bullish by a certain amount, okay? I wanna make sure everyone understands that before we move on to the next slide. So please type 3 into the chat window if this makes sense to you. The concept of when you're buying a call option, you're not just bullish, you also have to factor in what is the price of that call option and how far does the stock need to move in order for it to make sense for me to buy that call option. Okay, perfect. I see a ton of 3s. Great. So now what we're going to do is we're just going to take the exact opposite and say, okay, there was a buyer to that call option. Well, what happens to the person who sold that call option to that person, right? So same thing, right? We have a $70 stock. We sold the call option to someone for $1.50. So let's take a look at those same examples. Let's say I sold this stock, this was $1.50. I sold the call option to someone for $1.50. And we want to see, what does that person who sold that call option, what does that risk profile look like? So if the stock stays at $70, again, for those of you that know the answer, feel free to shout it out in the chat window. What happens if the stock stays at $70 after I sold someone a call option for $1.50 at $70? The answer is you gain $1.50 because I have the obligation to sell it to someone for $70. And if I can buy it on the open market for 70 and sell it to you for 70, then I don't make or lose on that transaction. But someone paid me $1.50 up front to have that obligation. So if the stock stays at $70, guess what? I make $1.50. If the stock stays exactly the same, I make that $1.50 because I can always buy on the open market for 70, deliver it to someone for 70, and I keep the $1.50 that I initially earned to get into this trade. And that statement is true for any price below 70 because guess what? No one's going to come to me and force and sell me a $70, have the obligation for me to sell it to someone for $70 when they can sell it, when they can buy it on the open market for a lower price, right? So I don't have the obligation to sell to someone at $70 for any price below $70. So basically, if it's below 70, guess what? I keep my $1.50. So if the stock declines anywhere from $70 or lower after I sell my call, I get to keep my $1.50. And that's part of why we say selling a call is bearish, because if the stock moves lower, you make money on the particular trade. Now, let's say the stock moves higher, right? I have an obligation to sell someone the stock at $70, but let's say the stock is now at $71.50. So I still have the obligation to sell to someone at 70, but I have to pay $71.50 on the open market to buy it and then sell it to someone for $70. So guess what? I take a $1.50 loss on that transaction. But someone paid me $1.50 initially to get into this trade. So guess what? At $71.50, I break even. Okay. Now, if the stock keeps going higher and higher, I still have the obligation to sell the stock to you at $70, but now I have to pay $73, $74, $75 on the open market to buy it before I can sell it to you for $70. And the further the stock goes, the higher my losses are. So what you're going to see is that as an option seller, what it looks like is it starts to look like this. Now, I'm not going to get into why someone would take this risk reward rate, why someone would want to do this. We're going to cover that in our next class. But it's important just to understand that an option seller, here's what you have. You truly have unlimited risk, because if the stock keeps going higher and higher, you're going to have more and more losses. And the only thing you have going for you is that $1.50 that you collected up front. That's going to provide a little bit of a buffer. So what you're going to see is that selling a call option has the exact opposite payoff to someone who bought that option. So in the previous slide, we looked at a payoff graph that looks like this, right? Or let me do this. In the previous slide, we saw, whoops, let me see if I can. In the previous slide, we looked at a chart that looks like this. And what you'll see is that the buyer and the seller have exact opposite payoffs, because they're on the opposite side of every single trade. So this is the fundamental building blocks of learning what it means to buy a call option and what it means to sell a call option. Because this is what you're going to need to learn and make sure that you fully understand before we jump into more advanced strategies and really thinking about how you can utilize options for your portfolio. So does everyone understand the concept of selling a call option here? Please type 4 into the chat window if that makes sense to you. Okay, perfect. So let's do this now. Let's backtrack a little and let's do a put option. What I'm going to do here is I'm going to use the same national bank, and I'm going to use a put option here. So let's take a look at what puts are going for. So that same April $70 put option trades for $2.20. Okay, so the put options here are a little bit more expensive, and let's see what that actually means for us when the put options are a little bit more expensive. The same $70, whoops. Same $70 call option, put option here. Here, instead of buying a call, we're buying a put option. And instead of costing $3, this costs $2.20. Before that call option, the call option costs $1.50. Here, this costs $2.25. So let's take a look at this. So as a put buyer, I have the right to sell National Bank stock at $70 to the seller of that put option, and I paid that person $2.25 up front for the right to sell it to them for $70. So let's say 2 months from now in April, the stock is trading at $70. What happens? For those of you that again know the answer, feel free to shout it out in the chat window, but very similar to the call option. What happens is, if I have the right to sell someone a stock for $70 that's worth $70, that transaction in theory is actually worth nothing to me. But I had to pay someone $2.25 initially to get into that trade. So if the stock stays at $70, guess what? I lose $2.25. So this is not a great transaction for me if I buy a put option and the stock does not move at all. And this is true for any stock above $70, because guess what? Why would I sell to someone a stock at $70 when I can sell at the open market for, let's say, $75? So let's say the stock is currently trading at 75. I can just sell the stock on the open market for 75. Why would I sell it to the buyer or to the seller of that put for just $70? So that's why for any price above $70, I just lose $2.25 because it doesn't make any sense for me to exercise my put option if the stock price is above 75. Now, if the stock declines a little bit, let's say the stock declines to $67.75, and I know that's a bit of a manufactured price, but bear with me for 1 second. If the stock moves down to $67.75, guess what? Now I can sell the stock to the seller for $70. That's only worth $67.75. So on that transaction, I make $2.25. But again, because I paid $2.25 up front, my net on that trade is actually zero. But as the stock moves higher and higher, lower and lower, what happens is I can continue to sell it to the seller for $70 on a stock that's worth significantly less. So what I can do is actually go on the open market, buy it for $60, and sell it to this guy for $70. And as long as I do it before April expiration, I have the right to do that for I have the right to do that for every contract of a put option that I have. I can sell 100 shares to that put seller for $70, no matter how much I can, no matter how cheaply I can buy the stock for. So what happens is the lower the price goes, the more this transaction is worth to me. The only thing that I have to hit, the only hit I have is the fact that I paid $2.25 initially to get into this trade. So a put option looks something like this. As the stock keeps moving lower and lower and lower, I can make more and more money. And then no matter what happens, even if the stock goes to 1,000, the most I lose is that $2.25. Okay, does that make sense, everyone? Please type 5 into the chat window. And what you'll see is that this is just a mirror image of a call option. So if you understood the first one, this should be a fairly easy one to remember. So that's how we say, that's why we say buying a put option is bearish, because as the stock moves lower and lower, you make more and more money. But the caveat here, again, is the fact that the stock doesn't have to just move lower. It has to move lower by a certain amount. In this particular case, that amount is the $2.25 we're paying for that put option. So you have to ask yourself, not only are you bearish on National Bank, do you think National Bank is going to go down to $67.75? If you think it will, guess what? It still doesn't make sense to buy that put option, because if it goes down to $67.75, you make zero on this. You actually have to believe National Bank is going to go below $67.75 before it makes sense for you to buy that put option. And that's a very distinct difference from just saying I'm bearish, because now you have to look at how much do put options cost. Then you have to ask yourself, do I think the markets are going to move to that level or lower in order for you to make that decision? And I think that is something that's not very obvious for a lot of people who are learning how to trade options, is that not only do you have to be bullish or bearish, you have to look at what the price of that option is and then factor that into whether or not you are bearish enough. Okay, so that's the most important thing that I want for those of you that are beginners to take away from this lesson today, is that you have to think one step further based on the price of the option to determine whether it makes sense for you to buy or sell a call or a put. Okay, so if that makes sense, everyone, please type 6 into the chat window. Okay, perfect. I see a lot of 6s. So let's do one last example. The person who sold the put for $2.25, right? So we had the put buyer. Now we have the put seller. I don't have to go through too many examples here, but I think what you'll learn very quickly is that that payoff graph looks something like this when you sell that put. Basically, when you sell that put for any price above 70, no one's going to take you up on the obligation to sell you the stock at $70 when they could sell it somewhere else at a higher price. So you keep that $2.25 for any price above 70. Where you have losses is if the stock starts to plummet. If the stock starts to plummet, what your payoff graph looks like is similar to this, which again is just a, based on all the charts that we've drawn today, I don't think is surprising. So the payoff graph of a selling a put option looks like this. Now, many of you might be asking, why the hell would anyone want to sell a put and take on this type of risk? Or why the hell would anyone want to sell a call option? And that's for a different discussion for a different day. But And the reason really just comes down to how much are you actually getting for that put option. Just like when you're buying a call option, you have to say, well, how far does the stock need to move in order for it to make sense for me to buy that call option? The person who's selling that call option is looking at that same price and saying, well, do I think that stock's going to move that much? If I don't think it's going to move that much, then it makes sense for me to sell that call option because I can make money even if the stock doesn't move, right? That's not a strategy that you can do in stocks at all. So if the stock doesn't move, you don't trade it. But in options, you can sell a call, you can sell a put and make money if the stock doesn't move. So, and as you can see, the put seller has the exact opposite payoff graph as the put buyer, which is denoted by the green line. So the green line's the put buyer, the red line's the put seller. And this is the fundamentals of options trading. Understanding when you want to buy a call, when you want to sell a call, when you want to buy a put, when you want to sell a put. Once you understand those four strategies, those are the building blocks of all other strategies of understanding where you should sell cover calls, when should you sell calls, when should you buy puts. Once you understand these four fundamental option strategies, everything else is going to make a lot more sense in the next few weeks as we explore these different strategies and we explore why you want to buy calls and puts, when you want to buy calls and puts, which expiration dates and what strike prices you should choose. These are all based on these fundamental building blocks. So it's important that if you learn something here today, to make sure that you review it and make sure that you understand it to a high degree before you progress with your trading. For those of you that are already trading options or familiar with options, I hope that this was a good refresher and a good reminder for you as to when you're buying options, or when you're trading options, what are the different metrics that you're really looking at, especially the price of a call or a put. It is so important to think about the price of a call or a put in the factor of whether or not it makes sense for you to buy or sell that call. So those are the things that I wanted to make sure that everyone understood before we progress into part 2 and part 3. So before I end this here today, I just want to do a quick poll again that's really going to help us better understand everyone here and help you guys build the community within Canada of options traders. So first of all, I just want to get a sense for, given that more than half of you are brand new to options trading, how many of you currently have an options trading account? Either yes, you have an options account, no, you don't, or even for those of you that you're not sure, just answer that as well. I just want to get a sense for how many of you currently have the ability to trade options and how many of you have not embarked on that journey yet. Okay, so it seems like the vast majority of you have an options account. Looks like about a quarter of you do not have an options trading account yet. That's okay. For those of you that answered no, we will do our best to follow up with you and help you understand how you can open up an options account at your broker. So looks like 72% of you answered that you do have an options account. And one last question before we break for today, just to get a sense for what brokerage firm do you currently trade options? What brokerage firm do you currently trade with? Whether you trade stocks or options, what brokerage firm do you trade with? Just so we have a sense for following up and making sure that you have the proper tools to execute these trades at your brokerage firm. We want to make sure that we provide as much support as possible beyond just the education and the tools here. Okay, so looks like I have a pretty good sample here. So with that, I just want to thank everyone for taking the time out here this afternoon. I didn't have a chance to really spend too much time on options play, but I promise you we will spend a lot more time on this. The next event and on the last event for March, where we're going to go over live market analysis, where we're going to spend pretty much the whole time on options play. And the reason for this, again, is to make sure that you guys understand the fundamentals before we jump into some of the examples and going through when you want to buy a call or a put, or which calls and puts you want to buy. It's so important to understand those fundamentals. So I really wanted to make sure that we spent that time with you, make sure that you had the time to understand these strategies, and give you the recording that you need to be able to to be able to review this information if you need to, because we did go over a lot of information. For those of you that are brand new, you might want to take some time to review. So we will make these recordings available to you along with the slides to make sure that you have access to everything before your next course in a couple of weeks. So with that, I want to thank everyone for taking the time out here this afternoon. I will take just a couple of minutes to try to answer some questions that you guys have put in during the session here. So Peter is saying something about leap options is safer. Leap options are really just for longer term views. They're not safer by any means. And it really doesn't have that much of an impact on your taxable account because they're still short-term capital gains. So Peter, leaps are useful if you have a long-term view and you want to apply some leverage, but they're not any better or worse than short-term options. It's just for longer-term time horizons. Peter saying, how do you trade options in very volatile markets? Simply by trading more often and being cognizant of your positions and monitoring your positions much more frequently than when markets are not as volatile. But the strategies still remain exactly the same. Should we stick with blue chip companies when trading options and never trade smaller capital ones less than $5 a share? So I would say that the price of a stock matters less than the market cap of the stock. So you might have some fairly large names with small dollar amounts and vice versa, small companies with large dollar amounts. So the dollar amount doesn't matter as much. It's really just the market cap of the strategy. Let's see. How do we judge if an option is expensive or not? Really good question, Alan. And I bet many of you are asking the same question. So Alan, here's a very easy trick of thinking about how much an option. Actually, let me bring up a spreadsheet that I recently made here on. Actually, you know what? Let me just do a quick calculation for you. What you can do to understand whether an option is cheap or expensive or not is just take the price of the option and divide it by the stock price. So if this particular case, when we're looking at National Bank, which is trading at $69.93, and the call option was $1.50, and the put option was $2.25, I think it was. All you have to do is take the option price and divide it by the stock price, and you'll get a percentage term. So in this particular case, this is about 2.1%. And what you'll see here is that 69.93 at $2.20 was 3.15%. So this is a quick and dirty way of getting sense for whether an option is cheap or expensive. Generally speaking, the cheaper end is about 2%. The more expensive side is going to be like 20–30%. Just to give you an example, for those of you that like to trade these fairly volatile marijuana stocks, looking at Weed Canopy. Weed Canopy is currently trading at $24.79. The at the money April $25 put option is trading at $3.55. That is a significantly higher price point. So I would argue that these weed options, even though from a dollar perspective is not much more than the National Bank one, it's $3.55 versus $2.22, but the jump in expensiveness is significantly more. So you should always utilize, the at the money options to compare this with, versus if we look at BMO, which is trading at $92, the at the money puts are trading at same $33.50, but it's a $92 stock. So the same $3.50, as you can see here, that's 3.8%. So out of all of these options, the National Bank calls were the cheapest, the weed puts were the most expensive, and TD was BMO here was somewhere in the middle. If you do enough of these, you'll start to very quickly see what's the higher end, what's the lower end. So that's a very quick and dirty way to get a sense for whether an option is cheap or expensive. I hope that answered your question, Alan. Do you have an email where we can ask you questions? Yes, you can send me an email at info@optionsplay.com, which I just sent to everyone in the chat window. And again, for those of you that are brand new, you can sign up for Options Play at optionsplay.com/TMX, which I just posted to you in the chat window. And for those of you to log in, you can just go to tmx.optionsplay.com. So I'm sending you a few links in your chat windows for those of you that want to sign up if you don't already have access to Options Play. Ed is asking, need to do a test to do spreadsheet, but not sure what I need. I'm not sure what you mean by that, Ed. If you can answer that, if you can let me know what you mean by that, I'm happy to help you out there. If I am bullish, may I buy a call or sell a put depending on where I see the opportunity? So next week, we're actually, or the next event that we're going to do is we're actually really going to compare buying a call, selling a put to help you better understand when should you buy that call and when should you sell that put, regardless of whether or not you have a bullish, or when you have a bullish view, whether you should buy that call or sell that put. So that's what we're going to discuss here next week. Kaz, you're very welcome. Gills, you're very welcome. Wallace, will you do a Canadian equivalent of your CNBC options show to talk about Canadian stocks? It's very possible. At this point, no one's asked me yet. I'm not actually sure if there are any Canadian options focused shows. I'm certainly open to it, but it really depends on when someone asks me to do that. Mark is saying it must be between 2 to 4%. Mark, no, some stocks are more volatile, right? So for example, Canopy, you're never going to find an option that's in that 2 to 4% range. You're just going to have to pay more on a more volatile stock. But banking stocks, I would say 2 to 4% certainly is in the range that you want to trade. This is not an absolute rule, and I don't think that I would ever want to teach you a rule like that. This is really just for you to experience and get a sense for how expensive options typically are, so that when you're trading, you can get a very quick sense of, hey, you know, things are a little bit more expensive than I'm used to. Because if you're trading options that you're used to in the 2 to 3% range, and all of a sudden one day it's 5%, you're going to say, whoa, something's going on here. The markets are implying a much bigger move, versus the markets are asking for a lot of money for that call option. I might want to rethink whether or not I'm buying that call option. And when you're just looking at a price like this, it's hard to judge whether something's cheap or expensive because it depends on the stock price. So it's really easy to do this quick division to give you a sense for what you're trading, because what you're going to notice is that when you're trading the banking stocks, they tend to be in that 2-3%. And then some days you're going to say, whoa, it's only 1.5%. Things are really cheap. Another day it might be 4.5%. You say, oh, it's really expensive. And that helps influence your decisions going forward. And that's something we're going to discuss in the coming weeks as to what do you do with a cheap option? What do you do with an expensive option? And just because it's cheap doesn't mean you necessarily should buy it. And just because it's expensive doesn't necessarily mean you should sell it either. So we're going to talk about some of those nuances in the coming weeks here as you guys progress with us on the education. So with that, I just want to thank everyone for taking the time out here this afternoon. Again, thank you so much for taking the time. I hope that you guys have found this useful from an educational perspective. These are recorded, so I will send you both the recording and the slides so that you can review at your own pace before you join us for the next course, so that you're up to speed before the next one. So thank you so much. I hope you guys have a great evening, and I'll see you guys in a couple of weeks.